All right, so we're going to take a deep dive into Barclays' 2024 annual report. I mean, it's a pretty dense document, but that's why you're here with us.
Hmm.
We'll break it down and pull out the really interesting bits.
Yeah, absolutely.
Their stated aim is to be simpler, better, more balanced, a UK-centered leader in global finance. Pretty ambitious, right? So let's see how they're actually doing.
Yeah, well, they've restructured into five business divisions to start. Barclays UK, Barclays US Consumer Bank, Corporate and Investment Bank, CIB, International Bank, and Private Bank and Wealth Management, PBWM. By simplifying their structure, they're hoping to create a more agile organization, which should mean better performance and happier customers.
Okay, makes sense. So let's break down each division, starting with Barclays UK. What's the story there?
They're laser focused on improving the customer experience, and it seems to be paying off. Complaints are down 36% and digital satisfaction scores are up. But they're not just going digital, they're also investing in traditional branches, A&D expanding their network of shared banking hubs. They opened 103 last year, aiming for 350 in the next 5 years.
Shared banking hubs. That's interesting. So multiple banks sharing a single branch? It's a clever way to keep costs down while still ensuring access to banking in areas where maybe it's not profitable for each bank to have its own branch. What's the competitive landscape like there? Are other banks doing the same?
That's a great question, and one we'd need more data on to answer fully, but it does show Barclays is thinking creatively about how to adapt to changing customer needs and economic realities. It'll be fascinating to see how this strategy plays out long term, both for Barclays and for those communities.
Absolutely. Okay, let's hop across the pond. What's happening with Barclays US Consumer Bank?
They're a steady player in the U.S. market, though the report doesn't go into much detail about specific growth strategies or initiatives there. It seems the focus this year is really on Barclays UK and PBWM.
Makes sense. They're likely the divisions where they've made the most significant changes and want to highlight their progress. So
Yeah.
speaking of PBWM, they're seeing impressive growth right now.
Definitely. Assets under management surged by 14%, and they hit a 28.1% return on tangible equity. Wrote fire.
28.1%. That's a remarkable figure. For those of us who aren't finance experts, can you explain why ROTE is such a key metric?
Sure. ROTE essentially tells you how efficiently a bank uses its capital to generate profits. A higher ROTE means they're squeezing more profit out of each dollar invested, which is great for shareholders. It shows they're using their resources effectively and delivering strong returns.
So a high ROTE suggests PBWM is on the right track. They're also aiming to be the preferred investment partner for clients across generations, which is a pretty bold goal. How are they approaching that?
One interesting detail is their focus on growing non-interest income. This means looking beyond traditional lending activities and expanding into things like wealth management, investment advisory, and potentially even insurance.
That's smart. Diversifying their income streams makes them less reliant on interest rate fluctuations and more resilient to economic downturns.
Exactly. It creates a more stable and predictable revenue stream, which is something investors always look for.
All right, so we've got a good overview of Barclays UK and PBWM. What about the Corporate and Investment Bank, or CIB? They're a major player globally, so I'm curious to hear how they're doing.
You're right, the CIB is crucial to Barclays' global footprint. They're involved in a wide range of activities, from advising on mergers and acquisitions to underwriting securities offerings to providing financing solutions to large corporations.
That sounds complex. What kind of trends are they seeing in the CIB?
The report mentions that the CIB is facing a challenging market environment, particularly in areas like investment banking and trading, global economic uncertainty, geopolitical tensions, and rising interest rates. They're all creating headwinds for the industry.
That makes sense. It seems like a lot of companies are being more cautious about big investments and deals right now.
Mm.
So how is the CIB responding to these challenges?
Well, they're focusing on advising clients on how to navigate these choppy waters. They're also looking for opportunities in areas that are less affected by the current market turmoil, such as sustainable finance and infrastructure investments.
It sounds like they're being strategic and adapting to the changing landscape. What about the International Bank? What's their role within Barclays' overall strategy?
The International Bank primarily serves clients outside of the UK and US. They're particularly strong in Africa, where they have a long history and deep roots.
It's a unique advantage. What are their key initiatives in the International Bank?
They're focusing on expanding their footprint in key emerging markets, particularly in Africa and Asia. They're also investing in digital banking capabilities to better serve their clients in these regions.
So they're tapping into growth opportunities in emerging markets and leveraging technology to reach those customers more effectively. That's a smart strategy. All right, we've covered all 5 business divisions. Now let's dive into the heart of the report, the financial highlights. How is Barclays doing overall, financially speaking?
They're in a solid position. Their Common Equity Tier 1, CET1 ratio, which is a key measure of a bank's capital strength and ability to withstand shocks, was 13.6%. It's down slightly from the previous year, but still within their target range of 13–14%.
That's good to hear. Can you explain what CET1 is and why it matters so much?
Sure, imagine a bank as a big building. CET1 is like the foundation. It's the core capital that helps the bank absorb losses and keep operating even during tough times. Regulators set minimum CET1 requirements for banks to ensure they're financially sound and can withstand economic shocks without collapsing.
So a higher CET1 ratio means a stronger, more resilient bank?
Exactly. And Barclays has been actively returning capital to shareholders through dividends and share buybacks, which is why the CET1 ratio has dipped slightly. It's a balancing act between maintaining a strong capital buffer and rewarding investors.
It's like they're trying to keep the foundation of the building strong
Yeah.
and also making sure the tenants are happy. And the ROTE was impressive, right?
Absolutely. They achieved a 10.5% ROTE for 2024, up from 9% in 2023. This upward trend indicates they're becoming more profitable and using their capital more efficiently.
Excellent. Now let's delve into the nitty-gritty of the financials. What are the key takeaways from their income statement?
The income statement shows us how much revenue they generated and what their expenses were over the year. In Barclays' case, their net interest income. The difference between what they earn on loans and what they pay on deposits is a major source of revenue. We also see significant income from fees and commissions, as well as their trading activities.
So they're making money from lending, providing various financial services, and taking calculated risks in the market. What about the balance sheet? That's basically a snapshot of their assets and liabilities at a specific point in time, right?
Exactly. On the asset side, you see things like loans and advances, which represent the money they've lent out, as well as investments they hold. Liabilities include customer deposits, which is the money people and businesses have entrusted to them, as well as any borrowings the bank has taken on.
So the balance sheet gives us a picture of how they're using their funds and how much they owe to others. What about the cash flow statement? I always find that one a bit trickier to grasp.
The cash flow statement is like a financial movie. It shows us the movement of cash in and out of the bank over the year. We see cash flows from their core operations, investments they've made, and financing activities like issuing debt or paying dividends. It tells a story about how they're generating and using their cash.
So it goes beyond just profit and loss to show the actual flow of money through the business. What about free cash flow? Why is that metric so important?
Free cash flow is the lifeblood of any company. It's the cash they have left over after covering essential operating expenses and capital expenditures. It's the money they can use to pay dividends, buy back shares, make acquisitions, or invest in growth opportunities. A healthy free cash flow gives them financial flexibility and options for creating value.
So it's the cash they have available to reward investors, grow the business, or just keep in reserve for a rainy day.
Precisely. And Barclays generated a significant amount of free cash flow in 2024. Which indicates they're in a strong financial position to execute their strategy and deliver on their promises to shareholders.
Okay, so we've covered the 5 business divisions and got a good grasp of Barclays' financial performance. What about their plans to create shareholder value? The report mentioned dividends and share buybacks.
Right. They've approved a total dividend of 8.4 pence per share for 2024, with payment coming up soon. And they're continuing share buyback programs. Buybacks reduce the number of outstanding shares, which can boost share price and earnings per share. It's essentially another way to reward shareholders.
Some critics argue that buybacks prioritize short-term gains over long-term investment. How would you address that concern in Barclays' case?
Well, it's a valid point, and it depends on the company's overall strategy. In Barclays' case, they seem to be balancing returning value to shareholders with investing in future growth. They're pouring money into technology, expanding into new markets, and adapting to the changing landscape. So it's not just about short-term gains, they're also making moves to secure their long-term success.
That makes sense. Okay, let's shift gears a bit and talk about sustainability. It's a hot topic these days. And no annual report is complete without addressing it. What's Barclays' stance on sustainability?
They're very vocal about their ambition to become a net zero bank by 2050. This means reducing their own operational emissions to zero, but also importantly, reducing the emissions associated with their financing activities.
That second part seems tricky for a bank. How do they plan to reduce emissions they're not directly responsible for?
It's all about financed emissions. These are the greenhouse gas emissions released by the companies and projects Barclays finances. So if they lend money to a coal-fired power plant, for example, those emissions are part of their footprint.
Ah, so they're taking responsibility for the environmental impact of the projects they support. How are they tackling this?
Well, they've set a target of facilitating $1 trillion in sustainable and transition financing by 2030. In 2024 alone, they facilitated $94.4 billion.
Wow, that's a lot of money. What exactly does sustainable and transition financing mean?
It's financing specifically directed toward projects that promote environmental sustainability or support the transition to a low-carbon economy. Think renewable energy projects, energy efficiency upgrades, or companies developing green technologies. Instead of financing that coal plant, they might finance a wind farm or solar energy project.
So they're using their financial clout to nudge the world in a greener direction. Do they give any specific examples of these projects?
Yes, one cool example is their support for developing CO2 storage infrastructure in the North Sea. This project aims to capture and permanently store CO2 emissions, which helps mitigate climate change.
It's encouraging to see them backing such innovative solutions. But with all this focus on sustainability, are they forgetting about managing traditional risks?
Not at all. In fact, they're incorporating climate risks into their risk management framework. They're conducting climate-aware stress tests and scenario analyses to assess their vulnerability to potential climate-related shocks. For instance, they're looking at how rising sea levels or extreme weather events might impact their loan portfolio or disrupt their operations.
That's reassuring. So they're not just chasing green investments, they're also thinking about the potential downsides of climate change and how to mitigate those risks. It's a holistic approach to sustainability, considering both the opportunities and the challenges. Okay, we've covered a lot of ground here, from their simplified business structure and financial performance to their commitment to sustainability and risk management. It's clear they've been busy, but what does it all mean for Barclays' future? Where are they headed?
Well, the report outlines some key growth strategies moving forward. They're planning to invest heavily in technology and digital capabilities to enhance the customer experience and improve efficiency.
Makes sense. Technology is transforming the banking industry at warp speed. They need to keep pace with those changes. What else is on their agenda?
They're also focusing on strategic initiatives to grow their core businesses, particularly in the UK. They seem to be doubling down on their commitment to serving their home market.
That's an interesting observation. What about challenges or potential risks they might face?
Well, no business operates in a vacuum. They acknowledge potential headwinds like economic uncertainty. Inflation is still a concern globally. And there's talk of potential recessions in some major economies that could impact their profitability and growth prospects.
Definitely. What about the political landscape? Brexit is still reverberating, geopolitical tensions are rising, and who knows what regulatory changes are around the corner.
Those are all valid concerns. Political and regulatory instability can create a lot of uncertainty for businesses, especially global banks like Barclays. It can impact their ability to operate across borders, comply with regulations, and manage risk effectively.
And we can't forget about the rapid pace of technological change. New fintech players are disrupting the industry, and even tech giants are dipping their toes into financial services. How can Barclays stay ahead of the curve?
You're right, the competitive landscape is constantly evolving. They'll need to be agile and innovative to stay relevant. The report mentions that they're actively exploring new technologies, like artificial intelligence and blockchain, to improve their offerings and streamline their operations.
It's interesting that they're embracing these cutting-edge technologies. It shows they're not afraid to experiment and push boundaries to stay ahead of the competition. But even with all the right steps, there's no guarantee of smooth sailing ahead. It's a complex and ever-changing world out there.
Absolutely. And while the report highlights their confidence in their strategy and prospects for future growth, they also acknowledge the potential risks and challenges they face.
It sounds like they're walking a tightrope, trying to balance growth ambitions with, a healthy dose of caution.
Yeah, that's a great way to put it. They're clearly aware of the challenges, but they're also optimistic about their ability to navigate them.
The report does seem to project an air of confidence, especially when they talk about engaging with investors and getting positive feedback.
Yeah, they highlight that they've been actively engaging with investors throughout the year, hosting deep dive sessions on specific business areas, and the feedback on their execution and progress has been positive.
Well, that's encouraging, right? I mean, positive investor sentiment can make a huge difference, especially in uncertain times. It can attract new investments, boost share price, and give the company more breathing room to execute its plans.
Absolutely. It's like a vote of confidence from the people who are putting their money on the line.
So all things considered, what's your overall assessment of Barclays moving forward? Are they on the right track to achieve their goals?
Well, it's tough to say for sure. The future is always uncertain, especially in a complex and rapidly evolving industry like banking. But based on this report, they seem to be making smart moves. They're simplifying their structure, investing in technology, focusing on customer experience, and taking a proactive approach to sustainability and risk management. Those are all positive signs.
It's almost like they're trying to have their cake and eat it too. They're a UK-centered bank with global ambitions, a traditional financial institution embracing cutting-edge technology, and a profit-driven company taking a serious stance on sustainability.
And that's perhaps the biggest takeaway from this report. Barclays is trying to find that sweet spot, that balance between seemingly competing priorities. It's a bold strategy, and only time will tell if they can pull it off.
It's definitely a story worth following. Well, this deep dive has been fascinating. We've gone from simpler, better, more balanced, to a nuanced exploration of Barclays' business segments, their financial performance, their commitment to sustainability, and the multitude of challenges and opportunities they face. It's been a whirlwind tour of the world of modern banking.
It has. It's been a pleasure dissecting this report with you. It's always intriguing to peek behind the curtain and see how a major financial institution is navigating the complexities of today's world.
And as always, we encourage you, our listener, to continue exploring. Dig deeper into these topics, question assumptions, and
Right.
form your own conclusions about Barclays' future. There's always more to learn, and knowledge is power.